Welcome to section 2 of your learning with us here at Handtech Markets. We hope you enjoyed section 1, which was introduction to Handtech Markets. And now we're going to cover introduction to FX. As I said before, you are welcome. This is the beginning, the start of your journey to become a profitable trader. And we hope that all the content here is clear and concise. And remember, if you don't understand the content being discussed today, please feel free to re-watch and watch the content again to your heart's consent. Okay? So today we're going to talk about FX. I know many of us have heard this term before. What is FX? What is foreign exchange? What is currencies? Here, we're going to describe what they are, so you now have a better understanding as to how you, the trader, can participate in this market. So as mentioned, the foreign exchange market has different names. Forex, currency market, currencies, it is all the same thing. This is the trading of one currency against another. And we as traders, we speculate on the price movement of those currencies. I'll break it down. So basically what happens is that we have one currency, which is, let's say, for example, US dollar. And then we then have another currency, which is maybe euro, for example. I'm in America and I want to buy something from Europe, maybe an engine, which is an example which I'll use later. That engine is costing in Europe a specific amount, but in US, I only spend dollar. So where the real origin of foreign exchange came from was from this: different countries buying and selling products to themselves. Unfortunately, we do not have a global currency. We do not share a currency all across the world, which is one. Some of us spend Naira, some of us spend Ghana cedis, some of us spend US dollar. All of these different currencies have their own rates. They have their own value and worth. So currency trading very basically is the rates moving across each other. You know, one US dollar does not equal one GBP, Great British Pound. But whatever that rate is where we as traders, when it changes up and down, that is where we then capitalize and trade and make money. So that is an overview of the origin of where foreign exchange really started. Basically, speculation of currencies against each other. So market participants, who can trade FX? This is a question that we get asked a lot. Many of us feel that it's only a particular individual that can trade, but no, we are part of this global village. We are all part of this global mechanism called the world. We all interact and engage with other countries, whether we know it or we do not know it, okay? So the market participants that are available who trade FX and who just trade generally, not only just FX, maybe gold, silver, coffee, wheat, oil, the indices, everybody can trade these things, from large commercial banks to central bank, the CBN, the Federal Reserve in America, they all trade. We then have Forex brokers that actually specialize in trading FX. We then have retail traders who are people like you and me. We trade, we also can speculate on the price movement or the exchange rate fluctuating. Hedge funds, money transfer firms, small banks and institutions, high net worth individuals, HNWs, all these people are able to trade in the Forex market. Understand? And you don't need $1 million. You can trade for as low as $100 in your account. Again, this all depends on what it is that you have in your account and what you want to get from the financial market. But one thing that I want everybody to understand here is that we are all participants. The big banks all the way down to myself being a retail trader. So as I mentioned earlier, the real origin of foreign exchange or exchange of currency really started with imports and exports, okay? In this example that I'll use here, which is very simple, is just the purchase of an engine. This engine was manufactured in Germany, okay? And then it is being sent to US. As I mentioned, we across the world, we do not share one currency. So what has happened now is that me, the buyer in US, I have my dollars. The seller in Europe, Germany, has his euros. I've now purchased using my dollars. I've sent that to my friend in Germany. He now has to convert my dollars into his local currency, which is euros. And that is real. This is what we call foreign exchange, okay? Currency exchange. Changing one currency from one area to another. So continuing, the engine price has its price in euros. That engine price in euros is 2,200 euros. But what I know is that there's an exchange rate. So my dollar to his euro, as you can see, has an exchange rate of 1.24. So for every $1 I own, it's equivalent to 1.24 euros. So for me to work out how much I'll pay in dollars is 2,200 euro times the exchange rate, which is 1.24. That will give me my price in dollars, which is 2,728. Okay, that is foreign exchange in its purest form, as simplified as it may be. And where we as traders or Forex traders, as you can see, the Euro USD rate is 1.24 in this example. This rate is always fluctuating. It can be 1.24 today. It can be 1.35 tomorrow. It can be 1.12 next year. This rate is where we monitor the financial markets, where things are changing. When I say things, this is interest rate decisions, inflation figures, GDP, growth of a nation. These all contribute to the foreign exchange rate, okay? So why do we trade FX? This is another question that we get very often. Why is it that we trade FX? So a currency cannot fluctuate versus its own value. So the US dollar cannot fluctuate against the US dollar by itself. Naira cannot fluctuate against Naira by itself. You need to compare this currency to another currency, and that is foreign exchange. And that is why we trade FX. It is something that has to happen. We cannot, as I mentioned, and I'll keep mentioning, we do not share one global currency. We only have the currency that we use in our locale. So when we then change somewhere else across the world, we need to know what the value of that currency is. A question that we will ask is, how many Naira will you give me for 1,000 Naira? That does not make sense because I cannot give you any more Naira for that 1,000 Naira. And that is where we say a currency cannot fluctuate versus its own self, okay? But what can happen is a currency can only fluctuate versus the value of another currency. In this example that I've shown is a student from Nigeria lands in USA and exchanges 100,000 Naira at the airport kiosk and receives $208 at the airport. The exchange rate is 480, i.e. $1 equals 480 Naira. Okay. And again, one thing that I want to make clear here is that we are not like a Forex bureau. When you're trading with Handtech, you won't bring us your physical Naira and we will then give you the dollar. No, what you are doing as a trader is you are trading on that difference. So today, Naira could be 480. Tomorrow, Naira could be 500. Tomorrow, all through the month, the changes in that Naira rate is where we as traders are trading, okay? So we are not exchanging your physical cash. You don't bring and take your physical cash. You just trade on the fluctuation of the price up and down. And again, we'll go into more detail as that comes by. So what are the requirements for me to get involved in FX trading? How do I begin? Okay. As I mentioned, it's very simple. Mobile device, so that could be your phone, your tablet, your PC, your laptop. You download our platform called MetaTrader 4. This is the vehicle that traders use to trade the financial markets. Connection to internet. As we know, and I spoke about in my first section, everything is online, everything is digital. For you to trade, you must have an internet connection. Whether it be through Glo, MTN, Vodafone, it doesn't matter. You must be connected to the internet. And then you then need a broker platform. And that is what we provide. That broker platform will then be downloaded and traded on your mobile devices. And the last thing that I put is startup capital. The advantage of relative stability in FX is complemented by the fact that small amounts can be used to start up. Small amounts. So clients can use as little as $100 to start their trading journey. Again, we are just the broker that gives you the platform. We do not give you capital to trade. You trade yourself. You have $100 in your pocket and you want to trade, bring that $100 and we can then assist you with that. We don't give you the cash so that you can trade. We are not prop firms. We're not financial account managers. No, we are just a broker that provides a platform. So I wanted to give a quick overview as to the top currency traders. Before, it used to be big banks. Like you can see JP Morgan, Deutsche Bank, Bank of America, Citi. These are all the top currency traders in the world. But this has now changed. It is now the retail traders that make up a large percentage of the market. Retail traders are individuals, me and you, not huge institutions. Me and you are the ones that are trading in the market. So the currencies that are the top traded by their value, very simple. I'm sure everybody has heard of USD. USD is the closest thing that we have to a global currency. Many of us peg our currency against the US dollar because of the size of their economy. USD is a huge, or America is a huge world power. Many things are bought and sold in US dollar. So that's why there are so many percentage, or the highest percentage of daily market share is traded through US dollar. You then have Euro, Japanese yen, the pound. These are all examples of currencies that are used to trade in the global financial markets. And then I'll go into a little bit more detail in my next slide as to what it actually means to be trading in these currencies. So you have the base currency versus the quote currency. So in this example, the base currency is GBP. So what I'm saying is one of my GBP, so one Great British Pound, is equal to $1.21228. I'm quoting in USD. So it's the quote currency against the base currency. That is what you will see. The numbers will always reflect the quote currency. So what we're seeing here is £1 is equal to 1.21 USD. Simple. The base currency in this example will always be one of that base currency versus the quote currency, which we see on the other side. And again, this fluctuates every single moment. 1.21228. Next moment, it'll be 1.21229. You know, that is a change. That is the foreign exchange rate fluctuating. So why is FX attractive? Why do I hear FX so much? Why do people like to trade FX so much? Why? Well, because it's open 24/5. It's the only financial market that is open like this. You know, oftentimes markets, if you're trading indices, they close. If you're trading oil, it closes. They have contracts. With FX, it is open 24/5. That means it's open throughout Monday all the way till, well, I say Monday, it's open Sunday night all the way to Friday evening. Okay, you can always change. It doesn't close during the week, so you can continuously trade. Why? Because the markets are always open. The countries are always awake. People are always trading, so the currencies will always fluctuate. It's extremely liquid, highly liquid. That means there's a lot of movement. You see the numbers ticking on your chart every moment. As long as the market is open, those numbers will tick. And that's what makes it very attractive for us as traders, because there's volatility. And all of these terms that I'm saying, when we start going through terms in section 3, you'll understand things like spread, liquid, volatility, leverage, all these things. It's the largest tradable market. And my next slide will go into detail as to what that actually means, the largest tradable market. Leverage, so that gives me the ability to trade more than my account size, okay? It's a great thing that brokers are able to support you with. We offer up to 500 to 1 leverage. And again, we'll be able to discuss this in our next section, in section 3. So as I mentioned, look at Forex markets compared to all the equity markets below. $7.7 trillion, should I say, is traded on this market daily. Let that sink in. $7 trillion daily. You can add all the major equity markets, New York, Tokyo, and London together, and it will still not attribute to anything like the Forex market. So that is why people prefer trading FX, because there's so much volatility, there are so much volumes being traded in that market. So you might ask, how do I understand the markets? You know, this is a question that we get asked frequently. Well, there are different types of analysis that will assist you. And inside our classes, you know, if you're a student at Hantech, we discuss fundamental and technical analysis a lot. Why? It's because this is how you really understand the market. Okay. Fundamental analysis is anything to do with news and economic data. Okay. So this could be retail jobs, GDP, population growth, the strength of an economy. These are all factors that we call fundamental. Anything that is news related, statistics related is fundamental, and that can drive the market. Fundamental analysis is something that can drive the market. We then have technical analysis, which many people enjoy, which is drawing chart patterns and understanding the charts. You know, a lot of things that we've been discussing so far is more the theory. On the platform itself, you will see the financial charts moving. You'll see the exchange rates fluctuating. So you use technical analysis to really understand that and break it down. And there are different forms of technical analysis, chart patterns, moving averages, indicators. Again, these are all things that you will learn through the course of your studies. And always ask questions. You know, you can ask your relationship manager, your account manager, they can detail what these things mean for you. Factors that cause volatility in the market. These are just 4 factors that I've placed down here. Not in any orders, but interest rates, monetary policy, political instability in a country, imports and exports. These are all things that are involved in the markets. These are all things that drive and make sure that there's volatility. So this is why we often tell clients to make sure that you understand, or at least have an appreciation of what is going on around you when it comes to trading. You don't want to be trading blindly where interest rate decisions are changing and it's affecting your charts and your position, and you don't know what is going on. So that is why we always tell people to have a good understanding as to what that is, okay? We'll go into deeper detail as the course goes on as to how to, or where you can find this information. So just make sure that you're following through your courses. And the last thing that I'll discuss with Introduction to FX is risk. Risk comes from not knowing what you're doing. This was a famous quote by Mr. Warren Buffett, who some of you may already know is one of the richest men in the world, who trades FX, who understands the financial markets. And he once said, risk comes from not knowing what you're doing. And that's why what you are doing here today in your course is important. Hantech will never tell you that there is no risk associated with trading. It's like any business, there's risk involved. But what we provide is the education to minimize that risk, because it will always be there. It will never disappear. And anybody that tells you that there's no risk in trading or it's risk-free, I would run from there, because that is a very scary statement. Yes, there's a risk, but that risk comes from not knowing what you are doing. And that is why learning and understanding how FX moves, what makes it tick and work, is fantastic and of great importance. So thank you for joining us on this session. We're going to now finish off. Again, if there's anything that you want more information on, please feel free to message your account manager, send an email to info@hmarkets.com, or just continue following through these courses. I'm sure any unanswered questions will be answered during the course of your studying. We'd like to thank you again, Hantech Markets.